The Fed raised rates and the 30-year fixed interest dropped. How'd that happen? Thanks for coming back to this channel where you get up-to-date market information so you can meet your real estate goals. So this article came out. This was in the news last week. The Fed raised rates. So why did mortgage rates fall? Came out in the Real Deal, informative website. So pretty much, the Fed raised the federal funds rate by a historic 75 basis points. At the same time that happened, the 30-year mortgage rate fell on last Wednesday to 5.54, on the Thursday to 5.22, and on Friday 5.13. So how'd that happen? So there's two things. There's two rates. The federal funds rate is the rates that banks charge for overnight lending, and so that affects the prime rate, or the rate that is charged for consumer debt. So that affects home equity lines of credit, credit cards, car loans, other consumer and corporate debt. Mortgage rate is completely different. The mortgage rate is determined by inflation, unemployment and jobless claims, and more importantly, supply and demand. And so there was very few homes for sale. Very few home sales. Almost no one is refinancing because the rates are so high. So the lending institutions are getting less business. So to stay in business, according to Ernest Sykes, there has been a pullback on new loan and refinance applications because of the general uncertainty in the economy. In order to counter this lack of demand, lenders drops their rates slightly. In other words, mortgage companies, banks are not getting lending business, so they drop their rates. So there's very few sales, very few people refinancing, so the rates drop. That's the answer. If you have any real estate questions, feel free to contact me. Otherwise, I'll see you on the next channel. Take care. Next video.